The so-called safest asset in the world is collapsing.
We all know there's going to be a reckoning in the bond market at some point.
The bond markets are saying you can't sustain this level of debt.
U.S. Treasuries, the foundation for the global financial system, are failing. And no, this isn't a temporary slump, but a structural collapse. And what happens next could impact everything from the job market to the value of your savings to the future of the dollar itself. Because when the bond market starts to go, everything else goes with it. But today we're going to look at exactly what has changed and why, how these changes impact you, and most importantly, what you can do to protect yourself against what's coming next. Let's get into it. U.S. government bonds have broken below a 40-year uptrend in what should be a massive wake-up call to everyone. But the incoming collapse isn't random. It's the culmination of years of easy money, fiscal overreach, and the weaponization of sovereign debt as a tool of control rather than a store of value. But I'm jumping ahead. In order to understand what's happening today and therefore what's coming next, we need to go back to the 1980s. And don't skip this foundational part as it informs what's coming next. In the decade after the dollar was delinked from gold, inflation naturally ran rampant and confidence in U.S. Treasuries was near collapse. But Fed Chair Paul Volcker stepped in and hiked rates to nearly 20%, breaking the back of inflation and restoring faith in U.S. debt. As a result, yields fell steadily over the next 4 decades, which drove bond prices up and made U.S. Treasuries one of the most profitable and trusted investments on the planet. But over the last decade, something fundamental broke. Government meddling, near zero interest rates, quantitative easing, and massive government deficits created extreme and out-of-control monetary saturation, essentially flooding the system with so much cheap and easy money that any regular or normal price signals were completely distorted. Meaning yields no longer reflected real risk. They were manipulated, which always works until it doesn't. Cue 2020. Trillions in stimulus floods the system at a time when we have these near zero interest rates. And what happens? Well, inflation comes roaring back. So the Fed is forced to have the fastest rate hike in history from near 0 to 5% in under 2 years. But this shattered the illusion that bonds were somehow risk-free because for the first time in decades, investors questioned the long-term stability of the U.S. financial system. Suddenly, it didn't look invincible after all. But it wasn't just concerns around the U.S.'s financial stability that caused foreign investors to step back. There was a far more critical reason. When the United States froze Russia's assets in 2022, it sent a clear message to the rest of the world. Your dollar assets are only safe as long as you're on Washington's good side. For countries like China and others, the freezing of Russia's reserves was a wake-up call that dollars were no longer a neutral store of value. They were a liability. That one move by the U.S. shattered the illusion that the dollar as the global reserve currency had any kind of neutrality, a characteristic that is essential for a global reserve currency. That started the clock, but the pressure didn't stop there. Then came the financial threats, the tariffs, or as many would call them, sanctions by another name, reinforcing the message that U.S. debt and U.S. dealings come with strings attached. So it's no surprise that foreign demand has collapsed. Just last month, overseas participation at U.S. Treasury auctions hit a 20-year low. This comes as China and Japan, 2 of America's largest lenders, are quietly dumping their treasuries and others are following suit. With fewer foreign buyers, the U.S. government is becoming increasingly dependent on domestic investors, such as U.S. banks. And ultimately, where does this lead us to? The lender of last resort, the Federal Reserve. But as if that wasn't bad enough, this comes at a time when the U.S. is gearing up for even more debt. We have trillions of dollars in debt that is maturing this year that is going to need to be refinanced at higher rates. On top of that, we now have the One Big Beautiful Bill, which according to the White House will reduce the deficit by $2 trillion over the next 10 years. But if you look at external reports like from the CBO, the Congressional Budget Office, they expect that the deficit will increase by $3.3 trillion over the next 10 years. And then if you look even further at people I trust personally, like economist Ray Dalio, well, his estimate is that it will increase the deficit by 20 trillion over the next 10 years. And that is if nothing changes. But that's a big if. We know that things always change, and unfortunately, most of the time they're not changing for the better when we're talking about this financial situation. No, if growth slows, then tax revenue slows, and we could expect to see interest rates increase to keep up demand for the debt, making all of these projections that much more alarming. And there's even a deeper force at work that no one's talking about: demographics. As millions of baby boomers retire, they're no longer paying into the system. In fact, now the government is paying them, meaning again, we have even less revenue and more spent. And if foreign nations and investors of treasuries are already concerned today about the fiscal outlook of the United States, imagine with all of these forces coming together where we're going to be in a year, in 2 years, in 3 years from now. Things are not looking good. The ultimate concern, of course, is that the risk will just be so high that no amount of rate hikes or incentive will justify holding U.S. debt. That is when we could see a true collapse of the bond market. But what does that actually look like for you? What does it mean if the bond market were to fail? See, most people I talk to in my real life, they don't want to hear about bonds. They think it's a Wall Street problem. What they don't understand is that a collapse in confidence in the Treasury market is going to impact all of us in every single way. First, borrowing costs are going to spike across the board. We're talking mortgages, business loans, auto loans, everything. Second, the value of existing bonds is going to fail. That is not good for pension funds, retirement, right? Banks right now are already underwater, hundreds of billions of dollars on existing bonds. What happens when they continue to stack those losses? Even a small dip in confidence could be the spark to ignite the next bank failure crisis. And that's just a dip. We're talking about collapse, which is far worse. See, the collapse of treasuries is the collapse of the dollar, the global reserve currency. The dollar's strength is reliant on the credibility of treasuries. This isn't just a currency concern. This is a systemic crisis. The U.S. relies on cheap borrowing to fund everything from Social Security to military. And if the debt becomes too expensive, the U.S. faces a brutal decision: default or print. But those who say, well, the U.S. will never default, they'll just print. It's an easy option, right? No, not so fast. You're missing the point. See, printing in a moment of panic is going to be a fast track for hyperinflation. Inflation leading to hyperinflation where prices could be doubling overnight. In that situation, any store of value that you thought the dollar had is going to be gone like that. The cost of living is going to go sky high, and life as we know it in the United States would be changed forever. And this wouldn't just be contained in the U.S. either. Countries around the world hold trillions of U.S. treasuries. If these went to next to nothing, then we could see a complete collapse of confidence in fiat currencies across the world. We're, again, not just talking about a recession or a depression. We are talking about a reset. But this isn't just hypothetical. This is exactly why central banks are actively preparing for this shift, positioning themselves now, moving out of debt and into real tangible assets like physical gold. Gold, which has outperformed bonds, protected wealth against every major currency crisis, and carries no counterparty risk, right? They don't teach you this, but these are essential understandings to protect your wealth against what's coming next. Now, if you want to learn more about that, this is what we study here at ITM Trading, our currency life cycles, and what smart money has done historically to protect themselves. Because by looking at and understanding these currency life cycles through history, we can then understand how to prepare, what strategy we need to have in place today for what's coming next. We have an incredible resource, the Built to Endure report. You can get your copy completely free, clicking the link down below to get your copy or scanning the QR code, whatever works either way. Just make sure you have your copy because, again, it is jam-packed with very important information that will help you protect yourself and prepare for what's coming next. And if you already have your copy, or you know that you need to get a strategy in place, or you want a second opinion, we are also here to talk to you and answer any questions you might have. So you can call us at the number below, or Click the link to set up a time that works best for you, whatever is easier. And in the meantime, thank you so much for being here. I'm Taylor Kenny with ITM Trading, your trusted source for all things gold, silver, and lifelong wealth protection. Until next time.